Operator-led private equity at Ethos. Erik Brooks. Speakers: Ted Sides, host, and Erik Brooks, co-founder and managing partner, Ethos Capital. Source: Capital Allocators, Inside the Institutional Investment Industry, Episode 504, YouTube, Capital Allocators with Ted Sides. Date: June 1, 2026. Part 1. The Case for Operators in the Room. Every private equity conversation with a management team carries a certain weight. The moment investment professionals walk into a meeting, an invisible tension appears. Here come the private equity people, ready to ask their questions. Even when those questions are asked in the friendliest, most open way, they still function as a kind of interrogation. Erik Brooks, co-founder and managing partner of Ethos Capital, has spent years watching that dynamic dissolve when a different kind of person leads the conversation instead, someone who has actually run a business. When his partner Fadi Chahad, a former CEO, sits across from a head of sales, the meeting stops feeling like an audit and starts feeling like two people who have done the same job comparing notes. Fadi might ask why a company organized its sales force by geography rather than by product line, drawing on his own experience running IBM's business services group across the Middle East and Africa. The answers that come back are deeper, more candid, and more useful, and Brooks, watching from the side, believes the quality of interpretation improves too, because someone who has actually been a chief executive or chief information officer reads those answers differently than a financial analyst would. Since a private equity firm's real product is not glass or metal or anything physical, but the information it gathers and acts on, better questions and better interpretation compound into better decisions, and better decisions compound into better long-term results. That idea, drawn out through first-hand experience, sits at the center of everything Ethos Capital was built to do. Part 2. From a Norman Rockwell childhood to the cold shower of reality. Brooks describes his upbringing as close to idyllic: two parents who loved each other, a sister, a good school, close friends. It was the kind of stability that builds confidence, but it does not teach the harder lessons that come from adversity. That lesson arrived when it was time to apply to college. Having assumed, as sheltered kids sometimes do, that hard work automatically leads to reward, he applied to every Ivy League school his parents dreamed he would attend, and over a single 48-hour stretch, he opened rejection letters from every one of them. It was a jarring wake-up call, and it reshaped how he approached everything afterward. At the college he did attend, Brown University, he became almost compulsive about preparation, at one point attending 2 sections of the same introductory economics class on the same day just to be sure he was not missing anything. That habit of leaving nothing to chance became a defining trait. After Brown, Brooks moved to New York and worked at DLJ, then Abry Partners, before heading to Harvard Business School. While there, he worked for Seth Klarman at the Boorpost Group, an experience he describes as transformative, one that injected him with the discipline of value investing and a rigorous way of thinking about risk. After business school, in the mid to late 1990s, he spent several years in Eastern Europe, working across Ukraine, Kazakhstan, Russia, and the Baltic states on the wave of post-Soviet privatizations. It was, in his telling, a period of humility and terror in equal measure. He was investing alongside backers like David Swenson, Julian Robertson, and Andrew Golden, buying stakes in companies for cents on the dollar and watching some of them multiply in value within a few years, which can make a young investor feel like a genius. Then the emerging markets crisis hit, and those same investments collapsed from roughly 70 cents on the dollar down to just a few cents, a reminder that the earlier gains had far more to do with circumstance than personal brilliance. He recalls living out of hotels without hot water for weeks at a time while his young daughter grew up mostly without him, and receiving a middle-of-the-night phone call warning him not to show up at an auction the next day because someone with the right connections wanted that company for themselves. Those years shaped a lasting appreciation for just how much local power dynamics, not spreadsheets, can determine outcomes in emerging markets. Part 3. Finding a home at Abry Partners. Uncertain whether Eastern Europe's opportunity would return in a couple of years or a couple of decades, Brooks had lunch one day in New York with Royce Yudkov, a mentor he had met years earlier, just before business school. In the middle of that conversation, Yudkov asked if he would be interested in joining him back in Boston at Abry Partners. Brooks said yes on the spot, before even discussing salary or title, because he trusted Yudkorf's intelligence and integrity more than he cared about the terms. That instinct, betting on people rather than on a specific deal or title, became a theme he would return to again and again over the next 2 decades. Abry's strategy at the time grew out of Yudkorf and his co-founder Andrew's years running Bain's media consulting practice. Rather than getting paid consulting fees for their sector knowledge, they would use that same expertise to invest their own capital directly. The firm specialized in media and communications, favoring businesses with stable, predictable, recurring revenue and high barriers to competition, and staying disciplined enough to filter out the noise of less durable opportunities. As media itself evolved, Brooks came to think of the category less literally and more conceptually, as technology-enabled content. That reframing let Abry follow the same underlying business model logic into adjacent areas like business services and healthcare, always asking whether a business had what he calls an expiration date. Customer service, for instance, is a permanent need regardless of what technology surrounds it, while other capabilities can be rendered obsolete quickly, especially now, in an environment being reshaped rapidly by artificial intelligence. Over his 20 years at Abry, Brooks watched the firm grow by hiring young bankers straight out of investment banking and training them over a decade into partners steeped in a shared philosophy of risk, return, and business model discipline, an approach that built a strong, cohesive culture. Part 4. Meeting Fadi and Taking the Red Pill. The idea for Ethos Capital emerged from what Brooks calls a wonderful accident. While at Abry, he led an investment in Vocado, an enterprise software company that automated financial aid processing for colleges and universities, and in doing so met its CEO and founder, Fadi Chahad. The two grew close over the following years, eventually selling Vocado to Oracle around 2015 or 2016. Around that same time, Brooks was noticing that private equity had become significantly more competitive, with prices rising in ways that made him, as a disciplined investor, uncomfortable. He began searching for a durable edge, something a private equity firm, which by nature moves slowly compared to a hedge fund, could build over the long haul. One idea kept surfacing, bringing genuine operating experience, people who had actually run companies as chief executives or chief information officers, directly into the investment process, rather than keeping them at arm's length as advisors. He brought Fadi in as a full investment partner rather than a consultant, and the effect, in his words, was revelatory and more than a little unsettling, like taking the red pill in the Matrix. Once you have seen how differently a former operator extracts information in a management meeting, you cannot unsee it. Working alongside Fadi as an equal, rather than as boss and advisor, Brooks watched firsthand how a peer-to-peer conversation between operators produced richer, more honest answers than the standard private equity interrogation ever could. That direct experience convinced him the model was worth building around, even though it meant walking away from 2 decades of deep friendships and shared history at Abry, a decision he describes as emotionally very difficult but intellectually simple. He realized what he and Fadi needed to build was not a slightly modified version of Abry, it needed to be something entirely new, an analogy he draws by comparing Abry to a 3 Michelin-star French restaurant serving 300 covers a night, versus the 12-seat Omakase restaurant tucked in a Tokyo subway basement that he and Fadi wanted to create instead. Part 5. Engineering Ethos from Scratch. The founding question for Ethos was how to scale the chemistry between Brooks and Fadi into a whole organization. Every partner at Ethos is someone Brooks or Fadi had personally known for at least a decade, recruited from their own networks rather than through a conventional hiring process. They built what amounts to a matrix, crossing the functional skills every company needs: sales, finance, technology, human resources, design, and more, with the specific industry sectors the firm wanted to invest behind. Those sectors were chosen for their exposure to durable macro tailwinds rather than fads: digital infrastructure, risk and resilience, financial services, supply chain, and digital identity, each one filtered further down to specific business models the team found most compelling. Because Fadi is an engineer by training, the two of them approached the build almost literally as an engineering problem, mapping every step of the private equity process, sourcing, diligence, and post-close portfolio work, and defining who does what, how long it takes, and which skill sets are required at each stage. Brooks describes the resulting operating system as looking, if you could see it, like the inside of a Swiss clock, dense with interlocking gears. integrating operating executives into functions like diligence, work that a chief revenue officer might never have done before, and getting everyone comfortable with an unfamiliar process, turned out to be the hardest and messiest part of building the firm, full of what Brooks calls spaghetti stains on the wall from failed early attempts. The breakthrough insight was letting go of the traditional private equity career ladder, where every partner has to become a generalist, a mile wide and an inch deep, competent across financial modeling, legal documents, banker relationships, and diligence alike. Ethos instead built an organization of specialists, each an inch wide and a mile deep, matching people to the parts of the process where their specific talents actually shine rather than demanding universal competence. Internally, the firm also built its own AI-powered operating system that feeds every email, calendar invitation, file, and note into a shared data lake and knowledge graph, giving all 16 partners, spread across different locations, real-time, asynchronous access to everything happening on a deal or portfolio company, an approach Brooks likens to Ray Dalio's principle of radical transparency, updated for the AI era. Part 6. One deal a year, and why concentration works. Ethos manages nearly $6 billion, yet by design, it targets only about one new investment a year, holding just 4 companies in its portfolio at the time of this conversation. Brooks calls the firm pistachio ice cream, a flavor people either love or cannot tolerate at all, but one that suits the firm's model precisely because Ethos commits so much operator time to each company it owns. A typical deal team at Ethos runs about a dozen people rather than the usual partner, principal, vice president, and associate, because 5, 6, or 7 operating partners join the investment professionals on every transaction. With 16 operating partners, all former C-suite executives from companies as varied as Disney, The Gap, Forbes, Google, Verizon, and Brinks, the firm can throw enormous depth of experience at the handful of businesses it seriously diligences each year, typically no more than 6 or 7 candidates. The obvious downside of such concentration is math. A single failed investment in a 5-company fund is a real problem. But the approach also frees Ethos from needing to force deals. In 2024, the firm did not complete a single new investment, and Brooks treats that as entirely fine, arguing that the resulting patience actually improves decision quality, since the team never has to settle for a mediocre opportunity just to hit a deployment target. As Ethos raises successive funds, Brooks is deliberate about which dimensions of the business are allowed to grow. Rather than doubling deal sizes and doubling the size of the organization in lockstep, Ethos has built in flexibility on deal size alone, having written equity checks as small as $100 million and as large as $500 million, often alongside limited partners who like to co-invest directly. Everything else, the investment team, the roster of operating partners, is intentionally overbuilt relative to current needs, giving the firm room to grow organically for the next 5, 10, or 15 years without having to reinvent its model. Part 7. Identity Digital, a case study in the model. Brooks walks through Identity Digital, the largest owner of top-level domain names in the world, including the rights behind roughly 173 million .com registrations, as an example of how the entire model comes together. The thesis began with a broad sourcing exercise, having identified digital infrastructure as an attractive category, and reasoning that the domain name system is effectively the Internet's identity layer. Brooks and Fadi met with the founders and executive teams of every company that owned top-level domain names before settling on the one they found most compelling. It took more than a year from that first meeting to closing the investment, ultimately convincing the founder and the venture investors behind the business to sell Ethos a majority stake based on the specific ideas the team believed would accelerate growth. The underlying economics explain the appeal. A domain name registration costs an individual or company on the order of $30 a year, often less than what a business spends on coffee or office supplies, yet it is close to mission critical. Without it, a company has no verifiable digital identity at all. Because of that mix of near-zero cost and near-total necessity, renewal rates are extraordinarily high, and the business carries EBITDA margins in the 60% range, double-digit top-line growth, and free cash flow conversion of 98%. Characteristics Brooks compares to another well-known domain registry business, Verizon. Winning the deal, in Brooks's telling, came down to convincing both Ethos itself and the sellers that the firm had something real to add, not just capital. That process runs through what Ethos calls acceleration vector roundtables, where all 16 partners brainstorm potential improvements across strategy, market positioning, and operations, often generating 20 or 30 raw ideas that get winnowed down to a prioritized list of 5 to 7. If a target business cannot generate at least 4 or 5 credible ideas this way, Brooks says there is no real edge in Ethos owning it. About 8 partners worked the original diligence on Identity Digital. Once the deal closed, that grew to 10 partners actively engaged with the company on pricing, channel expansion, mergers and acquisitions, and cost structure. The Identity Digital experience also taught Ethos some hard lessons. The investment thesis itself, durability, profitability, growth, held up exactly as expected. What Brooks underestimated was the difficulty of actually getting a management team to execute new initiatives on top of their existing day jobs and quarterly targets, which pushed Ethos to start directly staffing up management teams with additional resources rather than assuming existing staff could simply absorb more work. The firm also refined what it calls its FIT methodology, evaluating each proposed initiative on feasibility, impact, and timing, a discipline that was not fully developed in the firm's earliest years and that has since cut down on wasted effort and burned political capital chasing ideas that were never going to work. Brooks also emphasizes the importance of killing bad ideas quickly, noting that operators, by temperament, tend to want to will difficult initiatives into working rather than walking away, even when persistence is the real mistake. One especially memorable moment from the deal came from a partner whose background was in education, not healthcare. Looking at a healthcare administrative support business Ethos was evaluating, he observed that the company was functionally a school. It recruited people, trained them over time, and placed them into jobs. That reframing opened up ideas about recruiting and training efficiency that added roughly 500 basis points of margin to the base case, ideas Brooks says nobody would have generated by thinking of the business purely as a healthcare services company. Underlying all of this is a particular philosophy about the relationship between an Ethos partner and their day-to-day counterpart inside a portfolio company. Brooks describes it as a kind of sacred, confidential trust. Whatever amount of time a given initiative requires, whether it is a light monthly conversation about channel strategy or, in Identity Digital's case, 3 partners working nearly full-time to restructure the company's debt from a variable-rate loan into a fixed-rate securitized structure paying around 6.8%, the relationship only works if the operating executive on the other side believes that what they share stays contained between the two of them, rather than automatically flowing up to the board. Part 8, Exits, Success, and What Comes Next. Ethos's approach to holding periods mirrors its approach to sourcing. The firm looks to buy businesses without what Brooks calls an expiration date, and treats every year of ownership as an active choice rather than a passive one. He notes that meaningful financial performance from the firm's operational work often does not show up for 2 or 3 years, partly because Ethos deliberately underlevers its investments early on, having learned from past experience not to let a company's capital structure dictate its operating strategy. The exit decision, ultimately, comes down to a simple test. If the incremental rate of return from owning a business for 1 more year falls below the fund's baseline expectations, it is probably time to sell. Asked how he defines success, Brooks lists the expected financial metrics, investment returns, portfolio company performance, whether the firm is hitting its base cases, fundraising progress, but adds that organizational health matters just as much, low turnover, and people who are genuinely energized to come to work. Personally, he measures success by whether he is having fun, arguing that when the financial and cultural pieces are both working, that combination is itself the clearest evidence the organization is succeeding. Closing out the conversation, Brooks shares that cooking is his favorite way to unwind, putting on music and shutting out everything else. Asked which 2 people shaped his professional life the most, he names Royce Yudkorf, who taught him to distill complicated situations down to the 2 or 3 factors that actually matter rather than drowning in analysis, and his partner Fadi Chahad, who he credits with teaching him grace, the ability to step back, keep perspective, and make decisions without letting fear take over. Looking ahead, Brooks describes feeling like he is back at the starting line, comparing the next 5 years of Ethos to a gun going off at the start of a race, grateful, after a long career, to be building something new again alongside a group of people who share the same sense of mission and excitement. Operator-led private equity at Ethos. Erik Brooks. Speakers: Ted Sides, host, and Erik Brooks, co-founder and managing partner, Ethos Capital. Source: Capital Allocators, Inside the Institutional Investment Industry, Episode 504, YouTube, Capital Allocators with Ted Sides. Date: June 1, 2026. Part 1. The Case for Operators.